come back to you, Kevin. We talk about risk sharing or risk mitigation strategies. We talked about there's a valuation difference between the optimistic seller and the skeptical buyer. We have seen some optics in earnouts as a risk sharing mechanism. It's easier to finance probably when you don't have earnings visibility. Do you see that as a continuing trend or in?
I mean, we've certainly gotten a lot more creative over the past 2 or 3 years on how to bridge that valuation gap that it's always eternally there. It just happens to be wider than it usually is now. In terms of the different mechanisms, you mentioned earnouts. I'll give you some statistics. I mean, typically earnouts represent about 2 to 3% of all deals have that functionality and that feature. We're up to about 4% now. That doesn't seem like a lot, but when you go from 2 to 4, it's a pretty big increase in the number of times people are utilizing earnouts. The second is a structured sale, and I'll give you an anecdotal example. I got a call yesterday from a Fortune 500 company in the US who is looking to actually sell a subsidiary, basically do a divestiture. And instead of sell that for cash, they're actually going to sell it for stock in the acquiring company, which is highly unusual. But it's a way to bridge a valuation gap because they fundamentally believe that the acquirer has a wonderfully undervalued stock and that they're going to ride that up in a tax-efficient manner and make money on that trade. And so the ability to use shares as currency is a way to bridge valuation gap because you're not necessarily losing exposure to the asset like you would in a cash deal. And finally, there's structured transactions that have come into play, where instead of trying to sell 100% of the company, maybe you're only looking to sell 51% or 2/3 of the company. And instead of leaving it open-ended and having a question mark as to how it's ultimately going to be resolved, you will pre-agree a set of mechanisms to have that back end be taken out by the ultimate acquirer. Can be a put-call relationship, can be set at a certain level of EBITDA and a multiple associated with it. But there are definitely creative ways where you might not necessarily be able to get to a very clean 100% cash transaction, which was our lives basically in 2019, 20, and 21. But you're seeing a lot more interesting ways to bridge those gaps and still actually see the transactions that should happen.